Okay. So, good morning. I know I didn't. I didn't know last week was it's called a semester break for the exam. I literally prepared to go to the classroom 8 o'clock on Tuesday. And I was stopped by my colleague, told me the day before yesterday, they say, do you know the next tomorrow is actually is no teaching? I said, what? She told me that actually there is a semester break for midterm. So I was sort of astonished, and then I have to change all my schedule at the same time. But actually, I hopefully today there are some students are not in the class. As usual, they do. I hopefully that's not because of the holiday. I hope that's because they prepare for the exam, whatever it's related to academic. Okay. So what we're going to do is, first of all, we're going to spend some time. We're going to spend some time on the tutorial questions on the Modigliani-Miller theory. Why this is important? This is very, very important. How important it is? Let me tell you this way. In terms of the Nobel Prize, financial economics has won several Nobel Prize. Financial economics in Nobel Prize area, in Nobel Prize subjects, let's say subjects, it's a plural, okay? To my understanding, there are directly related to financial economics, there are at least three series. Actually, we covered two in this class. We covered two in the class. The first one is we spent 2 weeks' time on the risk and return. Risk and return. That's how we understand. That's how the financial economics was awarded the first Nobel Prize. And then somehow in 1990s, this theory has been awarded another Nobel Prize. Of course, in 1990 exactly, when I remember that, is Robert Merton awarded another Nobel Prize, which is in total there are 3 Nobel Prizes here. So what has been established in the Modigliani and Miller theory is try to help us, I mean, all the audience, academic, and the practitioner to understand many fundamental questions about the firm, many fundamental questions about the firm. So today we're going to go through, so basically what you're going to see today is in the tutorial question, is we try to see the theory or understand the theory from a slightly different perspective. So that's actually, I prepared the 3 questions by myself. As you can see here, the first one is, think about in the future, you will have either sit on the interview table or have a very casual, when I say casual, you have to pay attention. Nothing during the job interview is casual, as long as you talk. You're going to do something. Nothing is casual. You have to pay very attention to what people ask you, and you have to be very careful about how you reply to the interviewer on the other side of the table, because everything whatever you said, you do, is going to be recorded in the system, okay, and is going to be prepared for the evaluation. And then somehow discussion may be directed to the one of the 2 series, and in case there is MM series here, I want all the students here are be able to describe the theory or introduce or whatever the theory in a very concise, but is with full understanding perspective. That's what I want to for the first theory. Okay, you should not mix any characteristics for proposition 1 with the proposition 2, and what's the purpose for the proposition 1 and 2. Okay, so that's the purpose for the first one. And the second one actually is coming from one of, there are couple of students come to me say, well, if you change this, the proof in the exam during the, proof during the example you presented in the class, maybe we have a different answer. So in that case, to answer those questions, I prepare for the second one. It's say, let's say we should use the proposition 1 to get the result, which is the firm value is either indifferent with the capital structure if there is no tax, or the firm value is going to change. And when I say change, the theory told us that the change is to increase the firm value. And if the firm switching from pure equity finance to equity plus debt finance. So that's the proposition actually 1, 2 with tax altogether. And then what happened to the cost of equity, cost of the firm? So that's how we're going to understand in the second question is we try to see the question from the other side around. So let's say if our proof is correct, then some of the calculation that reach to the first conclusion that we change the firm capital structure and then the firm value is going to change should be wrong. And how to prove that is wrong. So that's what I want to do in the second question. In the third question is I try to enhance the understanding of what is so-called in the academic proof risk-free arbitrage. What's the key elements of a risk-free arbitrage? What is the strategy you are going to prove this is a risk-free arbitrage, and how many steps you are going to do, and what's the result we should expect? So that's the question number 3. Okay? So let's go to the solutions. Okay? So my suggested answer for the first one is proposition 1 is on the relationship of firm value and its capital structure. Okay? So you can see this answer and you try to delete any words from this one. If you delete any one word from this one, it seems like the answer is not full. You don't provide the full answer to this question. Above this one, you can add some other words. As long as there is no need to take the picture. I will going to make it release to the the Noodle on Friday in the afternoon to all the students here. If you want to add some other words on that, unless it's not as long as it's not going to contradict with the meaning here, you're going to find that that information could be said as redundant. Okay, so that's how I try to formalize this kind of question, and I try to let the students remember this is the way that you can answer as concise and correct as possible. Because anything in the future, you try to specify the answer in a correct way, but in as short as possible. The proposition 2 is on the relationship of cost of equity and the firm's capital structure. So if I summarize the 2 propositions, so you can even you can reshuffle the answers. So what exactly is theory? You can say, oh, theory is about capital structure. Well, capital structure is one key element, but it's not the full. The full picture is what? Full picture is about a capital structure and its relationship with firm value, and a capital structure and its relationship with cost of equity. So that's the 3 pieces altogether. So the other way you can say this is, what exactly is, for example, in the future, You went into an interview room, and the interviewer sit on the top of the table, say, what do you have learned in the Master of Banking Finance? He said, we learned some theory on the corporate finance. And they say, let's say, what exactly is the one theory you learned from them? You say, oh, I learned some risk and return. We know the CAPM, that's one direction. But the other direction you happen to run into is you talk about MM theory. If you bring up the MM theory, you have to prepare for all the follow-up questions that you are going to face. And they're talking about, okay, tell me what is your understanding about MM theory. You say MM theory is about capital structure. Then there's follow-up questions, capital structure about what? It says capital structure about, you cannot stop here, because once you stop here, people know that you're faking it, okay? So to show the understanding, you really need to engage. That's what we call engage. You need to engage one step at a time to drag people's attention on your side, to say, oh, this guy is really good. This guy really understands what he has learned, she has learned. So this is kind of information. Once a time, you just put one bait over there on the table, and the people is going to move on your side. So you say, well, we learned something about the MM theory. So the question is, what exactly is MM theory? Well, MM theory is about the capital structure. And capital structure, why the capital structure is important? Oh, the capital structure is important because it's going to relate it to, first thing, firm value, second thing, cost of equity. So what exact capital structure or MM theory talking about? Capital structure, firm value, capital structure, cost of equity. Then you bring up the answers here. Well, the capital structure with the firm theory is according to the MM1 proposition. If there is no tax, capital structure is irrelevant to firm value. But if there is a tax, the firm value would increase as the firm switch from pure equity finance to equity plus debt finance. That's very clear, crystal clear. People would understand. And then the other question is, what is the relationship about the capital structure with cost of equity? First of all, there are some related questions, say, why the cost of equity is important. Then that's another theory about weighted average cost of equity, capital that we discussed in the previous week. But for this week, we're talking about how cost of equity will change as firm borrows more. So the answer is, which is on the number 3 here, is cost of equity is going to increase for sure, period. But the increase could be further understood under the condition with tax or without tax. The cost of equity will increase more if there is no corporate income tax. That's coming from the theory here. If the t is equal to 0, 1 minus 0 would be equal to everything in the difference between kappa, or cost of asset. As I said here, cost of asset should be considered as cost of unlevered equity. Unlevered equity here. Okay? And the minus cost of the debt. Okay? So as you can see here, in 1 or 2 minutes, through those conversations, people could understand what is your understanding about this important theory. Okay, let's go back to the second one. So without the corporate tax, the capital structure is irrelevant to firm value, or levered firm value is equal to unlevered firm value. In other way, if there is a corporate tax, so firm value increases as a firm borrows more debt. or levered firm value is equal to unlevered firm value plus the corporate tax rate times that borrowing amount. But there is one caveat here, okay? Because this is coming from all the master level textbook, and we know that improve for this short formula, anything about the we assume this is a perpetuity debt. If it is not a perpetuity debt, the proof will be slightly different from this. And the proof will be much more complicated than this. Okay, so there is an assumption on this. And the third one, the cost of equity. So cost of equity will increase for sure as a firm borrows more. However, the increase could be reduced as we're living in a world where the corporate income is subject to government tax. So there is, about this formula, I want to mention three clarifications here. The textbook always use the word K or kappa or cost of assets. Well, there are other textbooks use other different notations, which I preferred a bit more. But following the textbook, I want to clarify, and I want students to understand is the K asset here actually refer to cost of equity. Okay? It's referred to the cost of unlevered equity. So when it is cost of unlevered equity, so the equity is also the firm value. So that's why it's cost of the firm value and cost of assets in the textbook. In many other textbooks, it's written in a different way. It's cost of unlevered equity. Okay? So in the future, during the interview, if you say the cost of assets, you have to make sure that you're going to follow up with a further clarification. Right now, we say the cost of assets is because the firm is purely equity financed. It's purely equity financed. So the cost of assets is same thing as the cost of equity. That's the first thing. The second thing is cost of unlevered equity is and should be higher than the cost of debt. As you mentioned to this one, this piece. This is an important one. Why? Because if cost of unlevered equity, or in short, cost of equity, could be lower than the cost of debt, then the conclusion of MM theory proposition 2 is invalid. It's invalid. So you're going to see that is the cost of, so it's going to build into your memory, cost of equity should be higher than the cost of debt. And that's going to lead a big theory, big empirical literature talking about pecking order theory. Pecking order theory means what? Means firm want to use some financing resources. And entrepreneurs were always started with financing resources which has the cheapest financing cost. And if it's the cheapest financing cost, they start from where? Start from internal cash, because that's most cheapest resources of financing. And then when they exhausted internal cash, they switch to outside financing. Then they face a choice. Outside financing, you can either borrow from cost of debt, or you can issue the equity, which you need to pay cost of equity. So which one are you going to choose? The pecking order theory says you start with start with borrowing debt. Why? Because cost of debt is much lower than the cost of equity. And the last resort is going to switch to the equity financing, which is the most expensive one. So that's another reason when we learn the weighted average cost of capital. You remember there is two questions over there. There is two projects. In the first year, the firm was doing a printing project with the cost of borrowing debt is 14%, but the borrowing cost is 10% for that project. It's in debt. So the firm decided to take on that project. In another project the next year, the firm found another project which can generate an internal rate of return of 17%. It's a 17% versus 14% project. But eventually we decided to reject that project because of what? Because in the project where the internal rate of return could generate 17%, we cannot get financing resources from the debt, which is much lower. The only financing resources is available to the entrepreneur is cost of equity. It's the equity financing which has a cost of financing at 18%. So that question actually tells you something about this one. Its cost of equity would be much higher than the cost of debt. Okay, that's the second. And the third one is if without corporate tax as theory proposition 1, then the cost of leveled equity, OS, in the textbook it refers to ordinary shares, is equal to the cost of unleveled ordinary shares or assets, whatever you want to call this, plus the debt value divided by equity value and times the difference between cost of debt and cost of equity minus cost of debt. Okay? So that's the first three. So anything or any question about MM1, MM2, with or without tax so far? I want everyone to be crystal clear, at least at this moment, at least in this moment. So in the future, if you have any problem, you can either go back to the question, refer to the textbooks. There are many textbooks on this. And of course, if I'm available, then you can come back to me. Okay. I think probably, I'm not sure how many of you, when you look at these questions, have really thought about that. I actually received a few inquiries. They're asking me, what exactly, we know something's wrong here. But in order to prove this is wrong, we actually really want to know what you're going to solve this. So I just tell the students, I said I'm going to release the suggested solutions next week. So just think about what you want to solve this one. And let's see, they're comparing the notes. Okay? So today is the time that I'm going to release my notes here. So what exactly is the question? The question say, we change the, here's the one. This is the one, the page 12. So we started with a pure equity financed firm. And we know there's 100 shares over there. There's some cash flow generated. And then through the cash flow generated, we calculate what is the expected EPS. And let's assume that all the earnings measured by the EPS will be sent out as a dividend. So we could use the perpetuity dividend growth model to calculate what's the value of each share. And through the share outstanding, we can calculate what's the firm value, which is 2,000. That's purely equity financed. So purely equity financed, 2,000 the dollars. And then someone bought the firm and changed the capital structure. Issued 1,000 debt and used that the proceeds from the issued $1,000 debt to repurchase 50 shares, so there are only 50 shares left. So it's 1,000 debt plus another 1,000 equity, so it looks like it's 2,000. Looks like. And we claim, at least one group claimed the firm value stayed the same. The other group came a different way. This is how they claim this one. They follow the same procedure, calculate once they changed the capital structure here, by issue of 1,000 debt and use the proceeds from the issued debt to repurchase 50 shares. They claim the firm value has changed. How they calculate that? They do the calculation like this. Well, the probability is not going to change because that's the economy independent of the firm's performance. The firm value will not change. Why? Because you purchase the firm and you change the capital structure does not change the real investment policy. That's in our assumption. That's what we assumed. Okay? You cannot change the real investment policy. And if the real investment policy stayed the same, the firm is going to generate the same cash flow as usual. So we have firm revenue 300 when the economy is in expansion, 250 when the economy is doing okay, and 100 when the economy is in recession. However, because there is borrowing in the debt, so the interest payment would be consistent regardless of the economy's situation. So you need to pay 100 when the economy is in expansion, and the same 100 has to be paid when the economy is okay or the economy was in recession. So after each, the net earning per share would be 300 minus 100 interest rate payment, and you divide it by 50 shares right now because we only have 50 shares left in the market. So the earning per share when the economy is in expansion is $4, $3, and $0 when the economy was in recession. And they also calculate, so what we don't know is whether there is something wrong here. And next one is also unknown. Expected earning per share for the firm leveled. We use the probability times earning per share during this period, and we sum them up. So that's equal to $3 per share. And also, each share's value is we use the dividend growth model, and with your $3 divided by the cost of equity. And how do we get the cost of equity? We must borrow from the cost of equity from 12.5 in the previous slides. Okay? So we got the $24. So we're not sure about this. We're not sure about this. We're not sure about this, let's say. And then the firm value, clearly this one is larger than the $2,000. So we're not sure about this. Okay? So there are 4 question marks here. And let's say which one is correct, which one is not. As we can see here, logically, the first question mark here, the EPS calculation, well, the firm borrowed 1,000. And the interest rate is 10%. Therefore, in the end of each year, the firm has to pay 100 interest rate. And this situation has nothing to do with the economy. Therefore, minus 100, minus 100, minus 120 is correct. Therefore, we know that this one is correct. This correct, this correct, this correct, this is correct. Okay? Let's see the other one. The expected EPS. From the theory in the risk and the return, we know how to calculate the expected return or expected anything. So expected anything would be the probability in that scenario, and it's value weighted. So it's a probability weighted. So you need to use the probability of A3 times the value, that's correct. And you sum the 3 scenarios together, that is also correct. Therefore, the $3 per share as an expected earning per share is also correct. So we know that this is correct. Okay. So let's move to the other one. In order to calculate the value of each share, we assume that all the dividend has paid out, all the revenue has paid out as dividend. So we could use the dividend growth model to evaluate what's the value of each share. So this is, in theory, this is correct. We use the dividend divided by the discount rate of each share, or cost of equity. Well, this is, in theory, is correct, right? Because that's a dividend growth model. But we have to think about what this is for each share. What kind of a discount rate for the cost of equity we're going to use? Can we use, let's say, the 12.5, which is cost of equity in an unlevered firm? To answer this question, we could refer to this formula. This is cost of leveled equity, this is one, is equal to what? Cost of unleveled equity plus another piece, which is definitely larger than 0. In our question, cost of unleveled equity is equal to 12.5%. Okay? And for this one, we could use 12.5%. What exactly is the cost of debt here? 10%, right? How I get a 10%? Well, 10% is coming from here. This is how I got a 10%. I issued 1,000 of that, and that is going to cost 10%. Okay? So let's go back again. So that's how we get 10%. How much is the debt here? 1,000. How much is the unlevered equity here? 2,000 or 1,000? Or some third answers here? Right now, how many agree this is 2,000? I see one. Any more? How many of you agree this is 1,000? Okay, I see another one. So the rest of the students here have no indifference? Could be either 1,000 or 2,000. 2,000? Okay, so 2,000, 1,000. That increased my vote. I vote for 1,000. Okay, so there are 2,000, 2,000. Rest of you? Indifference. Okay. Well, I argue this is 1,000. Why? Let's go back to the question here. So everything is based on the evidence, okay? The firm issued 1,000 debt here, right? So it's going to add 1,000 debt to the firm. But once the firm issued 1,000, the manager gets 1,000 debt proceeds from the investor. But the manager also did another thing. Use the 1,000 proceeds from issuing debt to buy back. Here's the thing. To buy back 50 shares. Right? So the shares outstanding right now only have 50. Each shares is equal to $20. So the equity here is 1,000. Any questions here? Say it again. Yeah, cost of equity is supposed to be cost of debt, yes. Here it is. We proved that. Therefore, if everyone is clear on this, we can go back to check. Therefore, where's my answer here? Oops. I need to clean this up. So it is okay to calculate the EPS. It is, however, not correct to calculate the share value. The problem is when you calculate the share value of $24 per share, you use the cost of equity from the unlevered firm, which is different from the cost of equity in the levered firm. This is coming from where? This is coming from MM theory, proposition 2. Okay? Students may ask, well, you have the MM theory proposition 1 first, and then you have MM proposition 2. We're in the proof of proposition 1. How can you use some result from the proposition 2? Well, let me say this way. The proposition 1 and the proposition 2 coexist in the real world. And the theory just first proved there is a proposition 1 and then prove there is a proposition 2. They are coexistent in the real world. Okay? So the real cost of equity in the leveled firm should be 2 pieces. Again, it's 2 pieces. First piece, cost of, let me write this one. This cost of unleveled equity plus, it's called financing premium. You need to pay extra cost to get external financing. And through the calculation here, we got this is a 15%. So you can see here. So the intuition is like this. From pure equity finance, change to equity plus debt finance is going to increase the firm value in one hand, but it's going to increase cost of equity on the other hand. Especially is with the tax. But with and without the tax, the change would be different. If there's no tax, firm value would not change. Cost of equity will increase for sure. With tax, firm value will going to increase. Cost of equity will also increase, but with a less degree. How much is that? You get the tax shield. Okay, so that's the whole picture about this. So once we got cost of leveled equity, which is a 15%, and we're going back, use the $3 divided by cost of leveled equity 15%, we got the $20 per share. So $20 per share, the firm value. So I can say the 5 here, the firm value. So leveled firm would equal to value of debt plus value of equity, which equal to value of debt would be 1,000 plus another value of equity would be $20 times 50 shares, that equal to 2,000. So we get the same fact, right? Okay, any questions on this? Any questions on this? No more question, we move on. Okay, the last one is we talked about this before, but I want to, everyone is comfortable with a, so this one is to show the example in writing. It's an example in writing. How exactly one is going to prove something with a risk-free arbitrage. So they have 2 meanings here. One is to show you in writing how to conduct a risk-free arbitrage. And the second one is to to further enhance the understanding how to use the risk-free arbitrage to prove theory, let's start with a proposition 1 without the corporate tax. As we said before, this is at the master level because you are master banking finance here, or MBA, this is the same level. So to prove at this level, we use some numerical numbers. That's sufficient. Once you're at the even higher level in terms of academic, let's say in the PhD level, the proof cannot use any exact numbers. We have to use alphabetic letters to make the proof. Okay? So there is even high demand that. But for this one, it is enough, sufficient, we could use the numeric numbers to make the proof. So how to show the proof of risk-free arbitrage, proposition 1 without corporate tax? Okay? So we started from unlevered firm, which has 100 shares outstanding. Okay, there's a shares, there's a typo here. So 100 shares outstanding, cost of equity 12.5%, firm revenue under different economic conditions is listed in table 1. We have expansion, 3/3, okay, half, and recession, 1/8. Firm revenues, you can make up all the numbers by yourself. 300, 250, 100, I just borrow from the lecture notes. So we can calculate the earning per share. How do we calculate the earning per share? Because this is equal to 300 divided by 100 shares. So we have $3 when the economy is in expansion, 2.5 when the economy is okay, and when it's in recession, that earning per share was $1. Now suppose the unlevered firm has been bought, issued 1,000 debt, and repurchased 50 shares from the market. Now the levered firm becomes 1,000 equity financed and another 1,000 which is debt financed. Okay. As you can see here, I use another detail of my suggested solution is I always use the word, especially for my presentation, I use the word, the unlevered firm has been bought. What does that mean? Is I try to defend. If I say there's another firm. Another firm could have a different firm revenue, which make the 300, 250, or 100 irrelevant here. So this is my defense. Okay? This is my defense. The leveled firm has been bought, and we have assumption here. You change the capital structure, we're not going to change the real investment policy. Therefore, the revenue should not change. So this is my defense. Same firm, just bought by somebody else, change the capital structure, but cannot change the real investment policy. So therefore, the firm revenue has to stay the same. Okay? So this is kind of like a detailed defense. Okay? For the leveled firm, its share could be calculated by the method 2, which is $20 per share. We use the cost of equity. We know that the cost of equity in the leveled firm should be higher than the cost of equity in the unleveled firm. So from 12.5% increase to 15%. And then the expected earning divided by the cost of leveled equity, each share is equal to $20. That's one way to show. To further convince the audience, here is a risk-free arbitrage to prove that the leveled firm and unleveled firm has the same firm value. Here is a detail of the buy-sell arbitrage strategy. For the buy position includes 2 shares of unleveled firm. It's 2 shares of an unleveled firm. How much is the cost if you want to buy 2 shares of an unleveled firm? Well, it's $20 per share. If you want to purchase 2 shares, then you have to pay $40. Now here comes the risk-free arbitrage. Is how do you want to finance the buy position? Remember, in finance, everyone we talk about the risk-free arbitrage, the ideal situation is we establish a position without paying the money out of our own pockets. That's the underlying assumption in the finance world, that they want to do something making profit. So this is how they make the risk-free arbitrage here. They want to establish a position. Here, the position would come from 3 different positions. Okay? So how do we say position? Position is a portfolio. Okay? This portfolio, you establish this portfolio without taking any money from your own pockets. So when I buy 2 shares of unleveled firm, there's a cost associated with this purchase. How much is the cost? $40. Of course, you can taking the $40 from your own pockets, you buy this one. But this is not called risk-free arbitrage. That's a risky investment. The risk-free arbitrage is you try to establish this position without paying the cost. How do you do that? Well, you borrow the money from the market. That's one source. The other source, you short sell something in the market. So here is a combination of financing resources. In the second leg is you treat this as a verb. The buy is a verb. Finance is not a verb. The finance the buy position by leg A and leg B. Leg A by borrowing $20 from the market. So in total, you have to pay $40. When you're borrowing $20 from the market, you still have to pay another $20. Where did you get another $20? Well, you're selling one share. If I can, it's short selling. So what exactly is short selling? Short selling means you sell a share doesn't belong to you. Actually, you borrow this share and you sell in the market. What you are expecting here? You are expecting the share price would drop in the future. And once you borrow the share from somebody else and sell in the market, and you have agreement in 1 year, in our example. In some other examples, it's in 1 week, in several days. You have to return the share back to someone who loaned it to you. Okay? You need to buy the share from the market again. So they're selling one share of leveled firms. Someone asked, why you have to make a share one sale, selling one share in the leveled firm? Because that's the only way to link the leveled firm and the unleveled firm together. Because that's what I want to prove. If I don't want to prove this one, I just can use the borrowing. I buy one share and the borrowing, that's enough. But because in this case, the purpose of this case is I want to show that the leveled firm and the unleveled firm are the same. I have to link them together. So I have to use buy in leveled firm, sell in the, buy on the unleveled firm, sell in the leveled firm. That's how I link them. But someone asked that. If that's the one you want to use or want to prove, why just use buy one share in the unlevered firm and sell one share in the levered firm? Of course you can do that. But the reason I'm doing this borrowing thing is in a broad perspective of risk-free arbitrage. Usually in the broad perspective of risk arbitrage, the position always associated with borrowing from the risk-free interest rate. So you see, I'm understanding why I want to do this. We take the trouble, okay? The reason we put a borrowing $20 in this position is try to show students that in a general methodology of risk-free arbitrage, we need to use involving borrowing from risk-free interest rate. It's in general. We're going to use this. Okay? And in order to relate the levered firm and unlevered firm, I have to put a buy position and a different sell position, one in the buy, one in the levered firm, the other in the unlevered firm. So that's why, because of the two consideration, I have to use buy two shares. Okay? So risk-free arbitrage, if it is not related to this question, we could set another two different risk-free arbitrage. We just buy one share, we borrow $20. Or we buy one share in the unlevered firm, we sell one share in the levered firm. It's all okay. It's all okay. But in the broader perspective, we need to borrow something. So that's why we want to set it in this way. Okay? And when you set up this buy and sell strategy up front, when you establish this portfolio, you buy two shares of unlevered firm, you're borrowing $20, financing part 50% of the buy position, and you short sell one share in the levered firm, your strategy at t equal to 0, the payoff is equal to 0. That's the payoff. You borrow $20, you short sell a levered firm, which is give you $20 cash. You have $40 together. You use the $40, go to the market to buy the unlevered firm for two shares. Each costs $20. That's $40. So you get $40 cash in, you pay the $40 cash out. That's 0. But we're talking about the risk-free arbitrage has a time period. So in the end of this year, you need, this is the other one, important. Let me erase that not important one. Let me keep this important one here. You need unwind all three positions. So every risk-free arbitrage has to do this. Every risk-free arbitrage has to do this. And this one is related to another very important exercise in the financial history. If you have time in the future, we can discuss another thing about the LTCM. Okay? Those are very famous guy here. As a matter of fact, LTCM, one was very popular, make a lot of money in the markets. They have a Nobel Prize winner as their management team, is Robert Merton. And they have the very smart idea to do the risk-free arbitrage, but the market forced them cannot do the rewind thing. And that's how they make that LTCM eventually for bankruptcy. Okay? So you have to remember this is risk-free arbitrage is a time window strategy. You establish this strategy in the beginning of the time window, and you have to close it. How long? We really don't know. It depends on. In the LTCM's question, there are spanned for a couple of years. In our example, the spans for 1 year. In the end of this year, we need to unwind this position. Now, how to unwind this position? Let me erase this one. Oh, I cannot move this. Okay, move this. Then I have to erase this. Okay. In the end of this year, when we need to rewind all 3 positions, we bought 2 shares of the unlevered firm. In the end of this year, we need to sell them. Those shares, those 2 shares, need to be sold in the market. Why? Because you need to use that proceeds to repay the money you have borrowed, the principal. Okay? So you borrowed $20. You need to pay the principal, which is $20, plus the interest rate. Okay? That's the first one. Borrowed. And because of this, the payoff is in the next table here. First of all, the firm after 1 year, the probability we're not going to change. The unlevered firm, UF, it's an unlevered firm. Because it's unlevered, your board has already bought, you have already bought 2 shares in the unlevered firm. It's 2 shares. So each share will generate $3 in the expansion, 2.5 in the OK, and $1 in the recession. So 2 shares, $6, $5, $2. But you have to pay the interest rate. Interest rate is $2, regardless of economic situation. $2, $2, $2, expansion, OK, recession. Therefore, total dividend for this buy position is $4, $3, which is equal to 6 minus 2, equal to 5 minus 2, equal to 2 minus 2. Okay? But don't forget there is a third piece here. You bought 2 shares in the unlevered firm, you borrowed the money, and there is a third piece here. The third piece is you have short sell 1 share in the levered firm. Right now, you need to buy it back. You need to buy it back. How much does it cost to buy it back? Well, buy it back, you need to the payoff is in the table 3 here. Same economy, firm revenue are the same. However, the interest rate paid, it's in the levered firm. That's 100, the payment. Therefore, the earning per share becomes $4, $3, and $0. Okay? When you compare the total dividend of the buy position and the EPS in the levered firm under 3 scenario, the step 4 to 6, this is an unwind position, will bring us the exactly 0 profit. 0 profit. There's no profit here. Therefore, this risk-free arbitrage proves the firm value has equal to 1,000. Okay? So this is the end of the proof. Any questions on this? Any questions? I would take a no. Okay, so we are going to, we're supposed to take we could take a break. Let's take a break. Let's come back at, let's say, 9:22, okay? Okay. So what we're going to do is we're going to finish next, including this one, have one more lecture. The other one is merger and acquisition. So today we're going to discuss a little bit on the payout policy. There are some learning objectives. Students are supposed to understand the significance of cash payment to shareholders, understand some institutional features of dividends, dividend payment process, and tax implication of dividend income. Students are expected to explain why the dividend policy is irrelevant to shareholders' wealth in a perfect capital market with no taxes. We need to understand the argument of payout decision could give signals to investors. We should be able to explain how the agency cost can be related to the payout decisions. We are too familiar with the nature of share buyback, dividend reinvestment plans, and other payout methods. So that's the objectives. This is something new. I added this, the figure from, oh, by the way, last time I tried this, but then some students said this is a good idea. I print out some emergency copies. Students are, because we upload the slides at least 1 week before, but in case you forgot about bringing that, each class I bring 30 copies, not enough for everyone. But it's 30 copies for those who forget to bring, just feel free. Why we're including in this the figure here? Actually, if you see this, this is coming from the Jonathan Berg spec book. This is a suggested textbook we're going to teach next year. It's more theoretical based textbook. Okay, that textbook is used in all top schools in the U.S. You go to Harvard, you go to Wharton, you see the MBA textbook, #1 textbook in corporate finance theory. That will be the one. So next year, we're going to upgrade the textbook to that one, which I like it the most. Okay. In that one, is give up a very clear picture on if the firm generate the revenue, how to distribute them, how to use the revenues. As you can see here, this is a use of free cash flow. See this one? That's the free cash flow. We talked about it before. Remember, we have a capital budgeting, the costs over there. We calculate how much is left for the free cash flow. So basically, you generate the revenue, you pay the cost, operation cost, you pay the interest rate, you pay the tax. So that's how we got the EBIT. And that's not 4. We have the EBITDA. So it's earning before interest, tax. What is a DA? Depreciation and amortization, right? EBITDA, that's equity. And once we calculate this, we still need to earmark some of the money that we're going to invest. That's a capital expenditure. We need to increase some inventory. That's also earmarked. So we cannot use that kind of cash flow. So once we minus all these capital investment, the research and development, capital expenditure, research and development, and the capital for the inventory, then what's the left over It's so-called free cash flow. So shareholder could use your discretion to decide whether and how we're going to use this cash flow. So that's called a free cash flow. So once it has a free cash flow, they have two possible streams they could use it. One stream is to retain it. The other stream is to pay out. So this one different lecture. Okay? We could spend another 3 hours on this one. It's empirical one. It's in corporate finance. Hundreds of paper talking about how to retain, invest in the new projects, and increase in cash reserve. And as a matter of fact, this one has a big literature, and this one has another big literature. Okay? But today we're not talking about those. We're talking about payout. This is what we're talking about. So we're going to focus on the payout one. In terms of payout, there are two kinds of payout. One is payout as a dividend. The other one is repurchase shares. So that's why I like this textbook very much. I like this chart very much. So when I decided that we're going to switch on these textbooks next year, so I make the first page of this chart available to this year's students here. Okay? So let's go back. So why is payout policy important to shareholders? A company's business decision involve investment, financing, and payout. Empirical studies suggest that the investors supply the capital to business only because they have the reasonable expectations that eventually they're going to receive some returns from the company in one form or another. Well, this is another academic paper, D'Angelo, 2007. This D'Angelo is a husband and wife. Okay? They're working in the University of South California. The husband and wife married together, and the gossip in the market is when they wake up 2 o'clock, 3 o'clock in the morning and start to do research. They're couples. Okay? Directors of company must decide how much cash, if any, to pay to the shareholders. Payout decisions involve distribution of cash. It affects both investment and financing decisions. Therefore, payout decision is a significant issue in many companies' operations. Please note, the decision on the company's payout policy should be consistent with the overall financing objective to maximize the shareholders' wealth. So what we're talking about in this subject is whatever the company decided to do with the payout, the cash flow, we have to follow one target. We have to follow one goal. The goal is try to maximize. The key word here is maximize shareholder wealth. So let me ask you the question. What if the firm pay out the free cash flow is different from maximize shareholder wealth? For example, the managers, they may not necessarily be the shareholder. Okay? Managers were not shareholder. So think about one company. They have lots of cash. So they never worry about, this company never worries about financing. Why? Because the company has a lot of cash. And therefore, what the managers of the company could do is to use the cash, because they have a lot of cash, to buy something that is very good for them, but not necessarily good for the company's shareholders. What kind of thing you can think about? The company needs to do business, right? So every travel, they stay in the 6-star hotel, buy corporate jets, sign up with a fancy golf club, right? Spend lots of money with politicians to try to get some connections, increase their social network. But all this spending has very little added value to the corporation at this moment. So this is called what? This is called investing in the negative NPV projects. And this is what? This is another literature talking about this. Agency cost. Agency cost, which we're going to discuss later on. Okay? So the key word here is maximize. You have to maximize shareholder wealth. Okay? So let's start with the dividend. Dividend is a common method used for companies to paying out cash to the investors. A company's dividend decision is at the discretion of the director. It's at the discretion, keyword, discretion. In theory, if the company is making a lot of money, then the company could pay dividend this year. Okay, here's another thing. The discretion means this. Even if the company makes a lot of money this year, the manager may decide not to pay out a dividend. That's a discretion. Okay? If the company lose money, suffer a loss this year, and the company manager make the decision to not pay the dividend, that's not a discretion. They're forced to do. The discretion means they have a choice to do A. They don't do A instead of doing B. That's a discretion. Okay, they have the money to pay dividend. They decided not to pay the dividend. That's a discretion. Okay? If they don't have the money to pay the dividend, they make the statement, we decided not to pay the dividend. That's kind of fake. That's not a discretion. In Australia, a company generally pays dividend twice a year. And interim dividend can be paid anytime before the final report is released, usually after half-year accounts are released. A final dividend is paid after the end of the accounting and the reporting year. The type of dividend. We have the regular cash dividend. The most common form is the regular cash dividend, which is paid on a regular basis. The size of the company regular cash dividend is typically set at the level that the management expects the company to be able to maintain in the long run. Barring some major change in the future of the company, of the fortune of the company. These dividends are generally paid semi-annual and are a common means by which the company returns some of the profits to the shareholder. The amount of the dividend received by individual shareholders reflect their proportion equity ownership in the company. So this is a cash dividend. In addition to a cash dividend, there are special dividend or other types of dividend. Special dividend is one-time payment to the shareholder. Special dividend tend to be considerably larger than regular dividend and to occur much less, I would say much less frequent. They are used to distribute unusual large amount of cash. Other types of dividend is a distribution of the value to shareholder can also take the form of discounts on the company's products, free samples, etc. The value received by shareholder is not in the form of cash, and the value received by the individual shareholder does not often reflect their proportional ownership in the company. Okay, 3 types of dividend. How the dividend is paid. Here is the process in general. This is the time. You can think about this as time. We started with the date with a board vote. So the board members hold a meeting, the board director of meeting, the vote whether they want to issue or pay the dividend this year or not. So the board vote, paying, let me change the color here. Paying or not. So when the board meeting is going to decide that whether the dividend is going to be paid or not. If it is yes, then the company is going to make a public announcement, and the date the public announcement has been made is called declaration date. Once it's declared, announced, you have to make sure what kind of investor are eligible to receive the dividend. So the last date, the investor are eligible to receive the dividend, it's called last date. Eligible. It's called ex-dividend date. Because the shareholder has a large amount of shareholder investors in the markets, and the record of those information is going to take time. Therefore, even if you have the last date which is illegible, then there is another date called record date. It's a very short window. It's short. Once has been recorded, then in a number of days in the future, then the dividend will be paid out. Okay, that's a dividend payout process. Okay, so the board vote. It is a process beginning with a vote by the company's board of directors, whether a dividend is to be paid. As shareholder representatives, the board must approve any distribution of the value to shareholders. So if the board decided to do a dividend payout, the board may also decide not to make the dividend payout. In order to announce the news, it's called declaration date. Declaration date is the date on which the announcement is made to the public, either decided to pay the dividend or not to pay the dividend. The announcement typically includes the amount of the value that shareholder will receive for each share that they have owned, as well as the other dates associated with the dividend payment process if the board decided to pay the dividend. The price of company shares often changes when a dividend is announced because the public announcement sends a signal, a message to the market about what management thinks the future performance of the company could be. So basically, when the company announced that the dividend is going to be paid, it is a positive signal to the company. No, there's a positive signal to the investor that the management is very optimistic on the firm's future performance. Otherwise, management, because it's a discretion, the management could say, oh, we don't want to, even if we have make profit, but we want to save the profit for the future. Remember, in the very first page, the company even if they have made a lot of money, they do not necessarily pay out. Because they could save the cash for the future investment. And if they save the cash for the future investment, the company could generate even larger profit in the future. So this is another big literature in the economy and financial economics, which is called delayed satisfaction. If you delayed your satisfaction, you're expecting what? You're expecting even larger return in the future. But for the delayed satisfaction, there is a possible cost, is what you project the future may not come true. So there's uncertainty over there. Therefore, okay. The announcement typically includes the amount of the value that shareholder will receive for each share that they own, as well as the other dates associated with the dividend payout process. The price of a company's shares often change when a dividend is announced because the public announcement sends a signal to the market about what management think about the future performance of the company. So once the news is announced, then move forward, we have the ex-dividend date. The ex-dividend date is the first date on which the share will trade without the right to the dividend. An investor who buys the shares before the ex-dividend date will receive the dividend, while the investor who buys the share on or after the dividend date will not. So basically, you need a date to distinguish who is eligible, which investor is eligible to receive the dividend. Okay. Before the ex-dividend date, a share is said to be trading cum dividend or with dividend. The price of a company's shares change on the ex-dividend date even if there is no new information about the company. These drops reflect the difference in the value of the cash flows that the shareholder were entitled to receive before and after the ex-dividend date. So the ex-dividend date is a date make the investor eligible to receive the dividend or not. So the price behavior around the ex-dividend date. In a perfect world, the share price will fall by the exact amount of the dividend on the ex-dividend date. So you can see here is if we take the ex-dividend date as t equal to 0, this is t equal to 0, and going forward is t plus 1, t plus 2, going backward, t minus 1, t minus 2. As we can see here, if we use this is equal to the price of each share. And this purple arrow refers to the price drop, which I would say is drop in this direction. On the ex-dividend date, the price would drop by the amount of the cash dividend. If there is a corporate tax, then the taxes are going to complicate things, and empirically the price drops is less than the dividend and occurs within the first few minutes of the ex-dividend. Okay. So once the ex-dividend date has passed, we move forward, and then there is a record date. The record date is the date on which an investor must be a shareholder of record. that is officially listed as a shareholder. In order to receive the dividend, the record date typically follows ex-dividend date by 4 days. The reason that ex-dividend date precedes the record date is that it takes time to update the shareholder list when someone purchases the shares. The dividend payment date after the record date, the final date that the dividend payment process is the payable date, when the shareholder of record actually receive the dividend. Once the dividend has been paid out, and in all the capital words, there is a tax over there. In Australia, we are moving from a classic tax system to a imputation tax system. So what's the difference between the two? In a classical tax system, profits of a company would usually be taxed by at 2 different levels. First of all, the profits will be taxed at the corporate tax rate level. And then, once the dividend has been paid out, and the individual investor receives the dividends, as the income, there is another income tax which is going to charge on the tax, on the charge tax on the income of dividend. So in this case, we see this is a double taxation. And in terms of the investor, the investor were facing marginal tax, personal tax rate. But in a advanced, more improved or imputation tax system, company tax paid are based on as a franking credit to offset taxable income. So how do we define franking? Well, actually, franking, this word is I learned by myself when I come to Australia. It seems like is, which I'm going to further explain, is they try to combine the taxation on both the corporate level and the individual personal level into one. So you can have some tax reduction if the company has already paid that profit, tax on the profit, and in the personal tax level, depending on how much is the personal marginal personal tax rate, and you can have some deduction or offsetting. Therefore, if they combine the 2 tax systems into one, then the purpose is to encourage that more dividend is paid out by the corporation. In order to show that mechanism of the imputation tax system, let's look at one simple example. First of all, let's look at the company level. Suppose this is it's the same company. It's one company, okay? It's a company ABC. So the company ABC earned 100 income as earning. Suppose this is earning off the interest rate, but before tax. And corporate tax rate, let's say it's 30%. Therefore, the profit after the tax would be 70. The reason that I'm putting another 70 here is because this $70 will be paid to different individual investor who may have a different marginal tax rate. Okay? Suppose the $70 will be distributed to different investors. Let's say 3 different investors. This is a investor 1, investor 2, and investor 3. The three investors have different marginal tax rate. They have 20%, 30%, or 47%. Okay, marginal tax rate. So the franked dividend is just to take the dividend that has already been charged corporate income tax at the firm level. So this one is equal to, we'll just take that from the corporate. And once you take about the franked dividend, you also take about the franking credit. What does the franking credit mean? Is how much the company has already paid for this amount of dividend. So this one is equal to this one, franking credit, is going to equal to this one. Franking credit. Company already paid about that, $30, 30%. So the taxable income at the individual level would be equal to franking dividend plus franking credit will be equal to taxable income. As you can see, that taxable income at the individual level go back to the original income earned by the company before paying out the tax. And for three investors. However, the calculation is for each of the three investors here, the tax payable depend by, according to the taxable income, will be different. Why? Because for this one times tax rate is equal to tax payable. For the individual investor 1, there is a 20% tax rate, marginal tax rate. So this individual investor, investor 1, needs to pay the marginal tax payment of $20. And for the investor 2, that's $30. For the investor 3, that's $47 because he or her that the marginal tax rate is 47%. But right now, if you charge the investor tax like this, we have also considered how much credit that the tax that corporate has already paid for the individual investor. Because the company has already paid $30. It's $30 company already paid. Therefore, we need to compare company already paid $30 and how much has not been paid. For example, for the investor number 1, company already paid $30. And then the investor needs to pay $20. Company already paid for $30, but the investor 1 only needs to pay $20. Therefore, the investor 1 get $10 tax credit. It's a credit. It's called a refund. You get some refund, you have extra credit over there. The additional tax payable. This tax payable. And in the number 2 case, the investor paid exactly the same amount as the corporate. So the investor didn't pay anything. In the third case, company paid $30, but the investor needs to pay $47. Therefore, the tax payable will be $17 more. Okay? So that's how that imputation tax system is calculated in Australia. Dividend irreverence theory. We come back to the Modigliani-Miller theory again. So what the theory says is company's dividend policy actually has no effect on shareholders' wealth. So there's a dividend policy, company's dividend policy, whatever the company's dividend policy has been made by the company has no effect on the shareholders' wealth. What are the assumptions for this theory? The company has a fixed investment and capital budgeting program. It's perfect competitive capital markets, no tax, no transaction costs, and no other market imperfections. Investors are rational, so always prefer more wealth to less wealth. Investors are indifferent between receiving dividend or capital gains. The dividend policy does not matter under the above conditions because a shareholder can always manufacture or remanufacture any dividend he or she wants at no cost when those conditions are held. The implication is that the investor don't pay a premium for a particular dividend policy. So we say that the investor is going to pay the cost if the firm is going to pay the dividend, but it didn't pay an extra cost for the different dividend policy. Okay? How to understand this? We'll go to the next one. So we use an example to show that the dividend's irrelevancy theory, let's assume the company T is, has the share outstanding. Each share is traded at $42, and the company is about to pay each share with $2 cash dividend. Suppose the individual investor B owns 80 shares, and this investor actually likes $3 cash dividend. So $2 is not enough. But the investor B could make a homemade dividend strategy by selling 2 shares of X dividend Therefore, by selling 2 shares, X dividend, so cash from the dividend would be before the sale of the 2 shares, because investor B has 80 shares. The company is going to pay 2 shares cash dividend. Therefore, the cash from the dividend is 160. The investor also made some cash from selling 2 shares, X dividend. X dividend. Therefore, the total cash the investor received is 240. The value of the shareholding would be $40 per share times 78 shares. Why 78 shares right now? Because he sold 2 shares, which is equal to 3,120. What if the company paid $3 dividend? Therefore, the customer is very happy with the $3. So $3 for 40 shares, for 80 shares, there are $240 in total. The investor was not selling any shares. The total cash is $240 from the dividend. because the investor still hold 80 shares, but by paying $3 of dividend, the share price dropped to this one is equal to 42 minus 3. And the total price, it's the same, 3,120. So this is not the proof, but this is going to show you the dividends is irrelevant. If the investor could replicate the company's dividend policy on their own at no cost, they would not care whether or not the company paid a dividend. In the above example, investor B began with a total wealth of $3,360, which is equal to 80 shares times $42 per share. So 3,360. After receive a $3 dividend, his total wealth is still 3,360 because that's 80 shares times 39 shares, which is equal to $42 minus $3 dividend, plus 240 as a dividend income. So the total wealth 3,360. And if the company didn't pay that much dividend, only paid $2 dividend, and the investor sells 2x dividend shares, his total wealth is still 3,360 because right now he has 78 shares of the selling 2 shares. Company paid $2 dividend, so the X dividend price for each share will be $40. He received a $2 dividend per share with 80 shares, 160. He also received a sale of 2 shares with X dividend price, $40 per share. That's $80 to go together. So in total, when sum everything up, the total wealth of this investor is still 3,360. So we can see that regardless the company pays $2 dividend or $3 dividend, investor B, wealth remains unchanged. If that's the case, what is the usual talk in the market about the information content and signaling hypothesis? Well, this is another literature in the financial economics. There is a signal literature saying that a company pays a dividend, send a good signal to the market, and therefore the price of those companies could increase. So this is the argument that a dividend is relevant to firm value in a world of information asymmetry. So in the previous slides, we're talking about there is no information asymmetry, which means what the company managers knows is exactly the same information as the investor we knows. What if this is not the case? Company managers suppose always know something that our investors don't know. Therefore, the literature tries to understand if this is what we're talking about as information asymmetry. Information asymmetry, information symmetry is the company managers knows exactly the same information as the investor knows. That's information symmetry. Information asymmetry is someone knows something more than someone else. But in this case, there is a company managers, there's investors. The only group that is supposed to know more information is the company managers. Right? The company manager is supposed to know the company more or better than the investors, or regular investors. So that's a literature about this information asymmetry and the literature about this signaling. Okay? This is corporate finance literature. What the academic literature has advanced is advanced to a new world. Think about some hedge funds. Some hedge funds know that the company is doing a bad job, not working very efficient way. So what they're going to do is, have you heard the journal articles or newspaper articles called hedge funds activism? As a hedge funds, they buy the shares from the company, and with the shares, the board, they get themselves into the board of the director. Once they move into the board director, they kick off the bad management and replace their own people. Why do they want to do this? Because that's another information asymmetry. So the literature right now talking about the management themselves is not necessarily the best person to know whether they should run the company in the most efficient way. So right now, the past literature talking about the manager knows more than the investor. But in the current stage, we have to qualify that statement. Is a manager perhaps know more than an average investor? But the manager does not necessarily know more about the company they are running than some very experts, let's say hedge fund activism. They know more, so they buy the company's shares, kick off the bad management, improve the management structure, and make the company generate more profits. That's another big literature in the hedge funds activism. Okay? So all these are coming from the information asymmetry. So the manager hate to cut the dividend. Why? Because they want to increase the dividend unless they think the increase is sustainable. Why that's important? Because this year's you put a dividend, let's say $3. Therefore, the investor would expecting you're going to do the same thing next year. But if you cannot make that promise, keep up that word, you're going to disappoint the investor. If you disappoint the investor, what the investor is going to do? They're going to sell your shares in the market. When the shares has been sold in the market, price will fall. It's going to send another signal to the investor who has less information to understand what's really going on in the company. So when people see that the stock price of one company is keeping going down, what's the usual interpretation? They don't go into the company's website or go to the SEC, download your balance sheets, download your investment policies, download your cash flow statements to do the analysis. They look at the stock price keeping falling, they say, something must be wrong on this company. They don't do the analysis. They just make their judgment call based on the information they have from the markets. So that's why the manager hate to cut dividend. So we'll try to keep the dividend as smooth as possible. Therefore, I see this is an interaction game, okay? Managers, investors here. Therefore, the investor, the view that the dividend increase, because the manager hate to cut dividend. So you're supposed to keep the dividend, once you decide to pay the dividend, supposed to pay the dividend consistently. But if the manager decides to increase the dividend, that's going to send the signal to the investor, say, well, if the manager, because the manager is supposed to know more than I do, if the manager decides to increase the dividend, that means that the manager is very optimistic about the future of the company. Therefore, a share price increase at the time of the dividend increase could reflect the high expectation of the future earning per share, EPS. On the other hand, If the dividend has been cut, then that would be considered as a very bad news that many investors may be expecting, and they could adversely affect the share price. So that's how we're talking about the literature, about the information content, information asymmetry, signaling, and I briefly talk about the two kinds of literature that has been involved in the past 20 years. Okay? When I was a PhD student, 2004, we're talking about information asymmetry as the manager knows more than the regularly investor. That's what I read when I was a PhD student. But after the graduate, right now, we are talking about there are another group of the investor which is not normal, which is not average. Who are they? They are some smart people. So let's label that smart people as the hedge funds activism or hedge funds activist. If you say they're a group of people, they're very active. Like someone, it's a Yan Kachin. They voted in the Yahoos, kick out their old management, that replace the new management and try to improve that the prophecy. There are many literatures, there are many academic papers talking about the story like this. So that's what we're talking about here, signaling. The benefit of the dividend. Once you paid something out, you pay the cash to the investor. So the first thing we're talking about is what's the benefits. And once we finish the benefits, we're going to talk about what's the cost. At least the one benefit of paying dividend is it attracts investors who prefer to invest in shares that pay dividends. So what does it exactly mean? It is true that the investor could simply sell some shares each month to cover the expenses. Well, in the real world, it may be less costly, and it is certainly less trouble to simply receive regular cash. Recall that under the MM conditions, there are no transaction costs. In the real world, the investor will have to pay brokerage fee, its commissions, each time the investor decides to sell the shares. So the dividend check, in contrast, simply arrives each half a year. A large regular dividend can indicate that a company is financially strong because the signal of the strength can result in higher share price. So that's one possible benefit of paying out a dividend. Another benefits, the dividend could also be used to solve agency cost. As we have this discussion before, like 10 minutes before, think about the company is so profitable, okay? The managers were investing in if the company is so profitable, so what does that mean? The company is loaded with cash. It's loaded with cash. They do not need to consider borrowing any external financing to finance their future investment projects. Is that, students may ask, is that kind of company exist in the real world? Yes, it does exist. I give you one example, as many of you have some, they call the gadget in your hands, the cell phone company, the iPhone, Samsung, those companies are loaded with cash, loaded with cash. So what they could do is they could invest in some negative NPV projects. What are the negative NPV projects? As I said before, the management could go to always stay on the first class when they travel. They build very fancy the buildings. They even buy the corporate jets. They signing up with a very fancy the club. So all these has nothing to do to contribute to the corporate future NPV projects. So that's what we labeled as negative NPV. remember, right now we're talking about a different group of people. Managers are not necessarily the shareholders. Okay? But the board of the directors are part of the shareholders. So what they could do is they could vote to pay the shareholder dividends, and that amount could even more than the excess, the cash that the company is producing from its regular operations. What does that mean? Is a board, think about this case, vote to decide the company is going to pay out all the cash to the investor. Okay? All the cash generated from the operation income has to be paid to the investor. The company needs to keep growing, invest in new projects, research and development. Where does the money come from? Because all the revenue has been voted by the board of the director to pay out as a dividend. Therefore, it's going to force the company managers that originally they want to spend this amount of cash as a corporate jets. Now they have to think about it. We have to borrow money to invest in the future investment projects. But my God, if we borrow the money from outside, we have to pay the cost. Therefore, they cannot borrow the money to buy the corporate jets. Right? They need to pay the cost of financing. If there's free cash flow, they could use that way. If it's borrowed cost, you cannot put into company's 10K annual statement. You say, oh, in order to improve our manager's life, I just borrowed the $10 million to buy a Boeing 787, and we borrow this money. We don't have the money. We borrow this. And if you produce some kind of statement like this, I would be very sure that the next year the managers will be driven out of the company. That's for sure. Okay? That's how we discuss in this paragraph. So then the money to pay the dividend will have come from the selling the equity preparatory in the public markets, and then they need to raise equity in the capital markets, which will help align the incentive of the managers with those of the shareholders. Okay? Okay, we have talked about the benefits. Let's now talk about some costs. So everything has two faces. If there's a good thing, then always have a flip side, which is not maybe not so good. Okay? So what's the cost about the dividends? Tax is among the most important costs. If a company pays dividend, shareholders have no choice but to receive them and then pay tax depending on their marginal personal tax rate. Think about the US. Their tax system may be different from Australia, and even in Australia, that its imputation system, we still have to pay the tax on the corporate income. And also, owner of the shares that pay dividends often have to pay brokerage fees if they want to reinvest the proceeds. You receive the dividends. What are you going to put the dividends? Well, usually you're going to invest those dividends in cash to some, it's called the financial investment vehicles. And in order to find the appropriate financial investment vehicles, you need to pay the brokerage fees. And that's going to associate with another cost. And to the extent that a company uses a lot of debt financing, paying dividend could also increase the cost of debt. Why? Because you remember that paying dividend is going to reduce the firm value. Can someone think about how this is possible? How that paying out a dividend is going to decrease the firm value? So once a dividend decided is being paid out, the firm value would be decreased this amount, which is exact in the perfect world, is exactly equal to how much cash dividend will be paid. Okay? So paying dividend is going to decrease firm value, and when you cost of dividend. So when the company decides to issue the debt, as we remember, cost of equity would equal to how many pieces? I like some of you can answer this question. In the leveled firm, how do we get the cost of equity? So this is another review about the Modigliani-Miller theory proposition 2. In the leveled firm, how do we get cost of equity? Value of what? Now we started with two big pieces. There's one piece, there's another piece. What's the first piece? Cost of asset. Okay. Suppose you are in a discussion with somebody, okay, which is professional. Think this is a work interview, okay? What is the cost of asset? What do you mean the cost of asset? Please explain cost of asset. Equity, cost of equity with unlevered, right? You need to follow up, okay? This is called engagement, okay? It's first piece, cost of equity in the leveled firm come from two different pieces. The first piece is coming from cost of unlevered equity. You can always say cost of assets that's coming from the textbook, but during the interview you have to prepare for this one. It's coming from cost of unlevered equity. Because the cost of unlevered equity is equal to cost of firm, cost of asset, because it's unlevered, right? You see that unlevered. You can think about that one is, you use the same formula over there, but because the cost of unlevered equity, the debt value will equal to 0. So the second piece totally disappeared. Okay? So keep this in mind. Okay? First piece, cost of leveled equity is equal to cost of unlevered equity plus a second piece. What is the second piece? I'm looking for this part. Someone has already answered the question on this part. I'm looking for this part. So what's the second piece? Say it again. There is no reason to shine at this moment. And actually, all the answers are welcome. Okay? What's the second piece? Premium. Okay, premium of what? Risk. Okay, risk. I heard the premium, I risk the financing risk. So it's financing risk. How that financing risk, how do you describe the financing risk and the premium financial risk? So you see that this kind of engagement. You have some correct answer, someone want to follow up, and you have to follow up. And eventually you can work together. How do you describe that premium of financing risk? Cost of what? Financing cost. Okay, how do you describe financing cost? Try to visualize what the formula tells us. Okay, there's one piece which is the value of the debt in the numerator and the value of unlevered asset. Unlevered equity, I always want to say as unlevered equity. Okay? Level of value of unlevered equity in the firm. Because you're starting with unlevered equity, you pull out more debt, right? So that's unlevered equity and the debt. So this is the ratio, this is the first part. What's the second part? see the cost. The cost of A minus cost of B. What is A? Cost of unlevered equity minus cost of debt. Okay? And this one tells us what? The cost of unlevered equity should be higher than the cost of debt. You don't need to say during the meeting, but it's going to help you to understand which cost is higher. So this knowledge may be used in somewhere else. Okay? So cost of equity is more expensive than the cost of debt. Remember this. And the third one that I told you, not in the textbook, is if somebody asks you, you have internal cash, you have external debt, you have external equity, you can choose from or finance. This is a very fundamental question. As a manager, as an analyst, there's always a question you have to answer first time. Think about a project in the future. Think about it. You move into the project, you're going to decide which project you're going to go. And we're talking about the cost of financing here. Okay? Which financing resources you're going to pick up in the first place? Internal cash, because of what? It's cheapest. Okay? Internal cash is the cheapest. Next one would be external debt, has to be debt. And the last resource is equity. Okay? Most expensive is equity, so that's why the equity holder really don't want to give up their control to the firm. If they have to hire somebody to manage the firm, which is a manager, how do they monitor the manager? How do they monitor the manager? They create a board of directors. So the board of directors is going to monitor the manager. If they don't do a good job, what are you going to do? They kick the management out. So this is that's a very beautiful theory about the corporate finance. That's why I love it so much, okay? So very nice. That's a very nice interaction. To the extent that the company used a lot of debt financing, paying dividend can increase the cost of debt, okay? We haven't talking about increased cost of the debt, most part in the textbook. But this is a tiny piece that author of the textbook revealed that the true information. Okay? Cost of debt of a company can actually increase. Okay? So remember this one. Because the corporate finance literature is such a large literature. We cannot just put everything in the textbook. So sometimes we have to make the judgmental call. So paying dividend could reduce the firm value. Given the huge discussion about the dividend, that's the usual treatment of the textbook. That's the usual treatment of the textbook. That's coming from the literature. Is if we go back to the very beginning of if we go back to this, thinking about this, we are not talking about this, we're talking about the payout. So payout, there are two methods. Basically, there's two methods. It's a repurchase share and paying dividend. And how on earth, if you look at the different textbooks, they spend 2/3 talking about a dividend, and perhaps no more than 1/3 talking about share repurchase and other things. Why is that? Because paying out a dividend is the most natural way to paying out the company free cash flow. That's very natural. A lot of companies doing that. Therefore, that's a lot of incidents we could analyze. That's how the academic is working. Okay, let's go back. Now we're talking about cost of dividend. Okay. cost of dividend. We finished that one. Now we're talking about advantage of share buybacks. Another way to pay out is to buy back shares from shareholders. Buyback gives shareholders the ability to choose when they receive the distribution, which affects the timing of the tax they must pay, as well as the cost of reinvesting funds that are not immediately needed. So what does that mean? If you're paying the dividend, you make the dividend payment, and from the perspective of the investor, you have no choice. You passively receive the dividends. And then, once the dividends has been sent to your account, you have to pay tax anyway. And if you want to invest, you have to make the reinvestment decision subsequently. But there's a major thing about this buyback is sometimes could be arranged. Okay? Shareholders who sell shares back to their company pay tax only on the gains they realize. And historically, this capital gains tax is lower than the personal marginal income tax on dividends. Okay? You see that a dividend, the policy here is it's quite different. Even if we spend a few years in the United States, you see this presidential election just revealed the case that Donald Trump, how they paid the income tax. And the rumor says that he has not paid income tax for the past 18 years. And why is that? Because the New York Times get an unauthorized documents. So far it's unauthorized documents. Could bring the New York Times to the legal suits. About Donald Trump in 1995, he filed a huge capital loss. So that capital loss, according to the US tax system, is bringing Donald Trump the future exemption from the personal income tax for 18 years. For 18 years. And suppose each year Donald Trump has $50 million personal income. So that tax system is designed in this way. If you suffered a capital loss, so first of this, the US tax system encourages people to invest, not to save. That's their purpose. Okay? So once you invest, you could suffer loss. If you could make a profit, they're going to tax you. But the tax rate for the investment is much lower than the income level. Okay? Tax rate on your capital investment gain is lower than the regular income. That's how the tax system designed. Okay? If you get a normal income, you earn $200,000, you're going to subject to 35% personal tax income. But if your regular income is low, but you made a lot of investment, and the investment has a capital gain, $200,000, it's the same thing as your regular income, the tax rate was much lower. What is that? Because the US society is a society to encourage investment in the future. That's their arguments. But your investment could suffer a loss. So how to compensate that? You tax people when they get a capital gain. How do you compensate people who suffer a loss? So that's going to have a tax exemption part that you record in 1 year, could be spread out in the future if you have further capital gain. So that's also fine. You see this one? And that's an advantage for this. The shareholder who sell the share back to the company pay tax only on the gains realized, and historically, those capital gains tax is much lower than the personal margin income tax on the dividend. So that's the whole story about this. From managers' perspective, share buyback provide great flexibility in distributing the value even when a company publicly announces an ongoing on-market share buyback program. As opposed to a regular cash dividend, investors know that the management can always quietly cut back and then the buyback at any time. So what does that mean? Is even if the management announces there will be a buyback plan in the future, and all the investors know that the manager could change the idea. They could change their mind. So unless the buyback has been exercised, anytime the buyback plan could be recalled. Recalled means they disappeared. And people know that. So the disadvantage of the share buyback, since most ongoing share buyback programs are not as visible as dividend program, they cannot be used effectively to send a positive signal about the company's prospect to investors. A more subtle issue concerns the fact that the managers can choose when to buy back shares in a share buyback program. Just like other investors, managers prefer purchasing shares when they believe that the shares are undervalued in the market. The problem is that since managers have better information about the prospects of the company than do other investors, they can take advantage of this information and to determine and which is detrimental to the investor. What does this say is, once the manager has this kind of power, and also because of the information asymmetry, we suppose manager knows more than the regular investor, then people will think about that, okay, because of the buyback is at the discretion, the manager always wants to spend the less money to do the more things. So when the manager decided to buy back the shares, it means what? It means the share price is much lower than its usual value, and if I sell the share back to the manager, which means I have been ripped off. So that's kind of another information asymmetry story here. Manager knows more than the regular investor, so that's a disadvantage of share buyback. In addition to buyback, there are several other, and which is in a decreasing popularity. So in the textbook, we put dividend is the first piece, second piece, buyback, and depends on different textbook. We have bonus shares, share splits. What is a bonus share? One type of dividend that does not involve distribution of value is known as a bonus share issue. When company pays a bonus share, it distributes new share on a prorated basis to existing shareholder. The only thing that happens when the bonus share occurs is that the number of the shares each shareholder owns increases, and their value goes down proportionally, and the shareholder is left with exactly the same value as before. Okay, so this is a theory that I just give you a few comments here. It's not very usual in the developed capital markets, especially like US and UK markets, but this method, bonus share, is very popular in some of the emerging markets, okay? And in some of the emerging markets, when they do the bonus shares, as a matter of fact, it's actually to the disadvantage of the investors. Why? Because they use the bonus shares to collect or harvest the new investment, the cash from the investor. A share split is quite similar to the bonus share issues, but it involves the distribution of a large multiply of the outstanding shares. We can often think about the share split as an actual division of each share into more than one shares. So reasons for considering bonus shares and share splits. The most often cited reason for bonus share issues or splits is known to increase trading liquidity and making share more affordable. They can send a positive signal to investor about the outlook that the management has for the future and can lead to a higher share price. I say this is only for the developed capital markets. management is unlikely to want to split the shares of a company 2-for-1 or 3-for-1 if it expects the share price to decline. And so far, that we have talking about the different payout policies. And we try to understand why the management make the decision which way to go. So there is a well-known academic paper survey on the dividend policy, which is published in very early 1956. The survey asked the managers about different industries and how they set the company's dividend policy. The key conclusions are, which is managers' consideration, companies tend to have long-term target payout ratio. Dividend change follow the shift in long-term sustainable earnings. Managers focus more on the dividend changes than on an absolute level of the dividend. And managers are reluctant to make the dividend change that might have to be reversed in the future. After about 50 years, another survey comes up reporting the finding which is similar to the previous one. Maintaining current level of the dividend per share is a high priority and is of similar importance to the investment decision. Managers have a strong desire to avoid dividend cuts. So the dividend cuts is not preferable in the management. Managers see little reward for increasing dividends and will consider doing so after investment and the liquidity needs are met. Dividends are inflexible and smoothed relatively to profits. Many firms that pay dividend would prefer that they did not. So you see that dividend is something once you gave to the investor, it's very hard to take it back. It's very hard to take it back. Share repurchase are very flexible and with no need to smoothing. Smoothing means, smoothing is another word, is you don't report the profit exactly as it should be. That's smoothing in our, especially in accounting literature. Repurchases are made using residual cash flow after investing spending. As you can see here, even if in the first, we go back again. Go back to this chart. Even if in this chart we show that this is a parallel retain payout. The modern literature shows that for the company perspective, they prefer to invest, which is this part, they prefer, but this is in the first priority if they have the free cash flow. And the repurchase and the dividend payout is something after the investment in the new projects. Why? Because as a company, if it wants to go, they have to the manager, where we are, maintaining current dividend per share is a high priority and is of similar importance to the investment decision. And a manager has a strong desire to avoid any dividend cuts. Managers see little reward to increase the dividend and will consider doing so after investment and the liquidity needs are met. Dividends are inflexible and smoother relatively to profits. Many firms that pay dividend would prefer that did not. Share repurchases are much more flexible with no need to smoothing. And the repurchases are made using a residual cash flow after the investment spending. So practical consideration, how to set the dividend policy if the company has decided to go on the string of dividend payout. A company's dividend policy is largely a policy about how the excess value in a company would be distributed to the shareholder. managers should consider several practical questions. On the long term, how much does the company level of earning, for example, cash flow from the operations, exceed its investment requirements, and how certain is that level? Does the company have enough financial reserve to maintain the dividend payout in the periods when the earnings are down and the investment requirements are up? Does the company have sufficient financial flexibility to maintain the dividend if unforeseen circumstances wipe out its financial reserves when the earnings are down? Can the company quickly raise equity capital if necessary? As you see here, raising the equity is most expensive. The firm will not want to go on this route unless it is necessary. If the company chooses to finance dividend by selling the equity, will the increased number of the shareholder have any implication for the control of the company? So the last one shows that if you want to sell the existing share to the new equity holder, does the old management or old shareholder lose the control of the company? So since there's a few more minutes, there is exactly example, vivid example about about the Bear Stearns, the collapse. So just a few months, when we went into 2008, somewhere in January and March, there is an investment banker searched the potential, because Bear Stearns was in bad shape. The first considering debt financing, and the debt financing has been cut off. They don't have internal cash. So the only way that they could survive is to increase equity financing. And we know that equity financing is very expensive. But because that's the only way for the Bear Stearns, go back to the 2008, in the very early, in the first quarter, so Bear Stearns has already accepted that, equity financing. But one thing that make the Bear Stearns shareholder or board of the director very hesitate to go equity financing is because the equity financing could make the current shareholder becomes a minority shareholder. This is what they want to avoid the most. And that's the major reason there are several potential deals about injection capital, as the equity financing to Bear Stearns was eventually being rejected by the board of the director of the Bear Stearns. And after that, because they run out of all opportunities of internal cash flow, external debt financing, and external equity financing, and for some reason that it's inevitable that Bear Stearns would going to fall eventually. Okay, that's pretty much I want to say. So the last ones show the reference, because some students always asking me if I want to read more, what's the better resources? Well, we use this textbook, Fundamentals of Corporate Finance. It's in chapter 17. That's all I want to say. And I have consultation hour just after this. For any student, if students have any questions, feel free to come to my consultation hours. Just step outside of the room if any students have any questions. Still have some spare slides if anyone wants. Spare slides? Yeah. somebody just come here, pick up on yourself. It's too far right now. Some more slides there. Pick up the slides. Yep. More slides. Yes. Okay, I only print out 30 copies. Next time I print a bit more. Okay. Okay, we can. Because there might be some one start class. Okay.